A stock you probably had not heard of 48 hours ago just moved 42% in a single trading session. That is not a typo, and it is not a meme stock revival. DPC Holdings Limited printed one of the sharpest single-day moves in its publicly traded history today, June 26, 2026. The volume signature was extraordinary. But here's the question that actually matters. When a micro-cap company moves nearly half its value in one day, is that a signal, or is it a trap? And do you actually have the framework to tell the difference before your money is already in the trade? Let us start with the foundation. Price does not move 42% on nothing. There is always a catalyst. And in small-cap markets, catalysts cluster into three categories: fundamental news, regulatory or contractual events, and what I call manufactured momentum, which is volume-driven speculation with no underlying business change. Identifying which category you are looking at in the first 30 minutes of a move like this is the difference between a disciplined decision and a reactionary one. DPC Holdings Limited operates in a niche that intersects physical infrastructure and logistics services. As of June 26, 2026, the move appears tied to a combination of factors that the market is pricing simultaneously. When you see a stock gap up and sustain that gap on accelerating volume, rather than fading back into the close, it typically signals institutional or, at minimum, organized retail participation, not just a news spike that evaporates by the afternoon session. Here is what you verify when something like this happens. First, pull the SEC filing history. An 8K filed within 72 hours of a major price event is almost always the upstream cause: a material agreement, a change in executive leadership, a significant contract, or a capital raise at a premium to market. Second, cross-reference the short interest data from the most recent settlement period. A stock with elevated short interest sitting above 15 to 20% of float can experience mechanically amplified moves when positive news forces short sellers to cover simultaneously. This is called a short squeeze, and it layers on top of genuine fundamental buying to create velocity that looks irrational, but is actually quite predictable once you see the setup. The actionable insight here is this: before you react to a 42% move, spend 8 minutes reading the most recent regulatory filing. That document will tell you more than 40 minutes of social media commentary. A 42% move demands one immediate question from anyone serious about capital allocation. Does the new price reflect a rational re-rating of the business, or has the market temporarily disconnected from fundamentals entirely? These are not the same situation, and they do not call for the same response. Here's the framework. When a company moves 42% on a genuine catalyst, say a contract that materially changes the revenue trajectory, or a regulatory approval that unlocks a new market, you need to model what that catalyst is actually worth in present value terms and compare it to the market cap expansion the price move just created. If the stock added $40 million in market cap and the contract is worth $8 million in incremental annual revenue at a 15% margin, the math does not support the price. The market overshot. Conversely, if that contract is worth $60 million in net present value and the market cap only expanded by $40 million, there may be room left. DPC Holdings is a smaller capitalization company, which means two structural realities are always in play. First, liquidity is thin. A relatively small number of buy orders can move the price dramatically when the order book is shallow. This creates price moves that look like conviction, but are actually just arithmetic. Second, analyst coverage is sparse. When institutional research coverage is low, the market is less efficient at pricing in news quickly and accurately, which means both overreactions and underreactions are more common than in large-cap names. This is not financial advice, and this is precisely the environment where that disclaimer matters most. Thin liquidity and sparse coverage are a combination that rewards preparation and punishes impulse. The actionable discipline here is to calculate the market cap change in dollar terms before you calculate anything else. Numbers ground you when momentum is trying to pull you forward. Here is what the data consistently shows about retail participation in stocks that have already moved 40% in a single day. The majority of volume that comes in after the initial catalyst spike is buying, driven by recency bias and the fear of missing out. And it is frequently the volume that the earlier buyers distribute into. This is not a conspiracy theory. It is the structural reality of how liquidity moves through a stock during a high volatility event. Beginners make a specific and recurring error in this exact situation. They see the 42% number. They feel an emotional urgency that this move will continue at the same pace, and they buy into a stock that is already trading at a significant premium to where it was the prior day. What they are missing is the risk-reward asymmetry that has fundamentally shifted. When you buy on day one before the news breaks, your downside might be 5 to 8%, and your upside might be 40%. When you buy after the 40% move has already happened, your upside to new fundamental value might be 5%, and your downside back to pre-news levels is 40%. The trade has mathematically inverted. In 2026, with algorithmic market makers and options flow dynamics more sophisticated than ever, these single-day spikes in small-cap names frequently resolve in one of two ways within 5 to 10 trading sessions. Either the price consolidates at a new, slightly lower equilibrium as the genuine fundamental value gets priced in properly. This is the healthy outcome. Or the price fully reverses as liquidity dries up and the initial catalyst proves insufficient to support the premium the market assigned in the heat of the moment. The single most valuable habit you can build from watching a move like DPC's today is this: track it forward. Write down your thesis for where it should trade in 30 days based purely on fundamentals. Then watch what actually happens. Over time, building that personal track record of predictions versus outcomes is how you develop real pattern recognition. Not by reading someone else's analysis, but by doing the work yourself and living with what the market tells you back. That feedback loop, done honestly, is worth more than any shortcut this market will offer you. We open by asking whether a 42% move is a signal or a trap. The honest answer is that it can be both simultaneously depending on when you enter and what you paid. The framework is what matters: catalyst verification, valuation arithmetic, and the discipline to recognize when the risk-reward has already flipped against you. Next week, we are going deeper into how to read options flow on small-cap breakouts before the price move happens. Subscribe so you do not miss it.